I've been seeing a lot of videos and articles about the poor man's covered call. So in this video, I wanted to walk through what it is, how it works, how you can set one up inside Interactive Brokers, and the math behind calculating things like your max profit, your max loss, and how it differs from buying shares outright versus doing the poor man's covered call. So, as you may know, a poor man's covered call is also known as a synthetic covered call or a diagonal spread. And it's great for reducing the amount of capital you need to enter into a long term play on a trade. We're going to look at Tesla right here in our watch list. It's currently trading at the 216 level. And what we want to do is go ahead and select the first part of our poor man's covered call, which is, of course, buying a leap call option. And to do this, we're going to track out and go into next year. So 2025, January is going to be our expiration date. And the reason you take this long dated or leap call option, you buy this acts as having 100 shares in your account. But as you'll see a little bit later in this video, it is much cheaper to just buy this call option versus actually owning the shares right now. So if you don't have a lot of cash in your account or you want to minimize your capital investment, focus on buying a long-term leap option to replace owning 100 shares. If I was to do this, I would target deltas around 90 or higher, just because when you have a delta, remember, this is telling you right here, this delta column, how much the value of this call option is going to change with every dollar move of the underlying stock. So if Tesla's stock price goes from 216 up to 217 and you have a delta of 90, it means that this option here is going to capture 90% of that dollar move. So every dollar that goes up, you're capturing 90 cents. That's what the delta means, which is what you want to have in your call option when you're buying it. So I'm going to go ahead and buy this 91 right here, the 130 strike price. I'm going to turn on strategy builder before I do that to make sure that it clicks in properly. So 130. Boom, we're going to buy that leg. And you always want to go far out in time with your leap option because you don't want theta decay to start ticking away and having time erode the value of this option too quickly. We can see here that theta is very, very low at only 4 cents per day. Very small, not going to be a negative anytime soon for our position. Now, the next half of this, right, we have this call option that we are buying, and we've got the mid of the bid ask there around, let's call it 101 right now, just for intents and purposes. And now the next part of this equation is going in and changing our strike price from 368 days to, let's go out one single month right now, one calendar month, 32 days away. And we want to pick up a strike price that is out of the money for Tesla, and we want to target, let's say, a delta around 25, maybe 30-ish. So let's go right in the middle there and go 28, 28 right there for the 240 strike. And why we are going to sell this, it is to help lower the potential loss in our position by 560-ish dollars. And also, if Tesla's stock price stays below 240, we can keep selling these covered calls in a sense. It's a synthetic covered call, I guess. And you can keep doing this month after month while you hold that leap option on the other end of your trade. So if we do this, and I'm going to get to the profit and loss and all the fun math in a second here, just showing the mechanics inside Interactive Brokers. You've got the bid-ask spread. It's pretty wide right now, governed by that long leap bid-ask spread. But let's get in here. Let's call this, let's just say this ends up being 954, the way the math is going to work out in this one. Okay, so we would go in here. We put this in for 95.4. Okay, and let's say that that's what our limit order is going to be. We would then do day, and we would submit that order into the hopper. And then there is our diagonal spread in there, the buy order for the 130 call and the 240 call in there for our long-term poor man's covered call. Now the fun part, looking at the math behind this to get a better sense of what we're doing and why this makes sense for a smaller account size. So I've preloaded this Google Sheet with a few different things here, starting with the type. We bought the one call option, we sold the other one. Tesla and its current stock price are shown there. And we've got our two strikes in here and the cost associated with each. So when we bought our call option at the 130 strike, remember the delta there is about 90. Let's go delta, put a new column in here, delta of 90, and the delta of the other one is around 28, okay? We're going to keep those over there on the right-hand side, just as a reference guide over here. We have a cost associated with buying this call option, this 130 strike, right? This one's the one that's far out in time. There's over a year date till expiration on this line right here. So it's fairly far out in time. It's going to cost us 10 grand and $100. Okay. We sold another call option and we got paid to sell that option with roughly a 30-day expiration. We got paid $560 or 5.6 times 100, 560, right? That's what's going into this trade. So what we can assume now is that if we want to go for a max gain on this trade would be if the stock price of Tesla went from 218 up and sat right below this 240 level right there on expiration of this call option right there. That's going to give us really close to our maximum gain for now. Okay, for now. And how we calculate that, we have the max profit down here, right? You want to have the strike of the short call. So you want to have 240, right? Minus the strike of the long leap call of 130. You want to subtract the price of that leap, which is the cost right there. And you want to add in that premium that you received for selling that short call, which is this 560. The max gain for this trade is 1460. And again, this strike here for the short call and the strike of the long leap, you have to multiply those by 100 to get the full value of those, not 130 and 240. It's those times 100 each because there's 100 shares in each contract. So if I open up the formula right there, right, you see D4 minus D3. So 240 minus 130 multiplied by 100 to get that conversion into the option contract, right? We add in this negative number because it's negative $10,100. And then we go plus 560 to add in our profit to get this combination, giving us our maximum gain for this setup right now of 1460, okay? Which is pretty good. And this is why people choose to do a poor man's covered call, because if you were to buy 100 shares of Tesla, right down here, it would cost you $21,889. And if the price appreciates up to this 240 level, we would then have a value in our account of 240 times 100, and we'd have $24,000 in the account. It takes almost 22,000 to get there to have this appreciation. And if we take our total profit from there, if we were just to say sell those shares at 240, we would walk away with $2,111, which is pretty good day's work, right? Pretty good for that kind of level, but you have to invest a pretty good penny to get there. We're investing $10,000 in this example, just over 10,000, and we're also offsetting that cost by $560. So it's really this $9,540. I'll get this number in a minute. That is our kind of capital investment in this case, getting us a potential return of 1460 if this price goes up to 240, which it very well could, which we are assuming it will in this example down here if you buy the shares outright. So would you rather spend $22,000 almost for a $2,000 return, or spend $9,500 for a potential $1,400 return? That's where you have to kind of weigh the pros and cons. And if people don't have a ton of cash in their account, a poor man's covered call, by the name and the definition, can be a great alternative. Now, let's talk about that maximum loss right there. This number here is calculated, as you can see, the max loss down here, right? It is the cost of your long call. So this number right here, subtract the profit that you got for selling the short call, so 560. So all we do in this example is we take this negative number and then we add our profit to it, and we go negative 10,100 plus 560 gives you the $9,540 maximum loss for this trade. Okay, so again, this is a risk reduction type of trade. If you don't want to invest a lot of capital here, right, versus $22,000, you have a lower investment and your maximum loss is capped at $9,540, okay? Whereas your maximum loss in this scenario down here, right, it's your entire capital position right there of that 21 and change. Obviously, you can manage your trade as you go, but that is a bigger number, just going by straight digits right there, versus the max loss potential of a poor man's covered call. The other thing I want to bring up, which is a kind of game changer potentially, is that you can sell this call option right here month after month, potentially, assuming the stock price of Tesla does not fluctuate or go too high. If it continues to move lower, you can definitely keep selling these call options and keep banking in profit, which is going to let you gain a little bit more each time and actually bump this number up and keep this number growing. You're going to be able to bump up 560 plus, let's say, like 400 if the next one's worth $400. Then maybe the next one's worth 300, right? Every time you sell this option right here, this call option every month, you can potentially be increasing your maximum potential gain based on the number of these call options that you do sell. Again, it is limited to the price movement of Tesla, which is why selling these kind of poor man covered calls works best when the market is kind of staying neutral or moving up slightly. That's kind of the best scenario to get the most bang for your buck in terms of this covered call and this poor man's covered call setup. That's where you want to be. That's where you want to move right there, neutral or moving up slightly. You would not want to do this when the stock is on a moonshot or just ripping crazy high, because in that scenario, you'd be better off just buying the straight up call option, letting it ride and just go to the moon with it. Or in that case, buying the shares outright if you had the capital to do so and just going and riding it all the way high. You don't want to cap your upside on this kind of moonshot if you can help it. That's where kind of the selling of the call option comes in when you're deciding to kind of cap your upside. When you do this and you buy the call option, if it's kind of by itself, it can go to the moon. It can go forever, basically. The stock keeps going up. You're going to keep making money on this call. When you sell the call and you have that other kind of piece to the pie, you're going to cap your gain at around this 1460 level if you're just doing this one time. This is our beginner level explanation of a poor man's covered call. As you can see, there are intricacies to this. Why did I pick a delta of 90? Why did I pick a delta around 28? There are reasons for that. There are reasons for the expiration dates that I picked as well, thinking about time decay and different things affecting the option premium. You also have to do a fair bit of technical analysis to understand that this neutral or up moving slightly market is likely to happen and how you can kind of manage your trade if it doesn't. If it does moonshot or just goes on a crazy heater, what can you do? How do you play defense? Those are all things that I've explained in another video, assuming you guys got some good value out of this one. And if you did, please like this video and keep following along to the channel. It means a whole lot to me if you do. Thank you for watching so much, and I will see you on the next one.